So welcome to another episode of Phillip Trading Podcast. So my name is William and our speaker today is Mr. Daniel An, which is a full-time trader and also a CME group speaker. Okay, so as we all know that inflation at the moment globally is very, very high, very insane at the moment. Okay, and the Federal Reserve at this juncture seems like they are very determined to really tame the inflation like really push down the inflation using the monetary policy at the moment. Okay, so the monetary policy by the Federal Reserve will have a very huge impact on how the US indexes going to perform next. So let's listen from Mr. Daniel okay, on his view on what is going to happen on the US indexes after all these possibility on the monetary policy by the Federal Reserve. Okay, so how have you been, Daniel?
Very good, thank you, William.
Good to hear that, and it's good to see you again. Okay, so I will pass the rest of the podcast section to you for you to give us a preview onto your webinars that you are going to share with us on the 25th of May. There you go.
All right, guys. Thank you very much for the introduction, William. Now, we all know that inflation has been with us for quite some time now. Actually, inflation started to rear its ugly heads sometime in March last year, but it wasn't severe then. And the Federal Reserve has been feeding us one narrative, which is inflation is transitory, meaning to say that it is temporary in nature, nothing to worry about, it will somehow disappear. And 1 year later, today we are definitely seeing a very severe inflation, not only in the United States, but I think it's worldwide. Okay, and there are a lot of drivers behind why inflation is so high now. For one, we have the US-China trade war launched when Donald Trump was the president, and that sets the motion as to higher import prices, but most of the impact were felt by only American consumers. The rest of the world has more or less been sheltered, okay? Then came the pandemic. Now the pandemic, what happens is nations around the world responded by locking down most of their economy. They closed down their borders and everybody is asked to stay home, work from home, and nobody is allowed to leave their premises. So that caused a breakdown in economic activity. Everything came to a standstill. So that caused a global supply chain disruption that led to global inflation reeling its head. Okay, then of course we know what happened this year. This year we have the war in Ukraine that complicate matters a lot worse because of the economic sanction imposed on Russia. And of course, both Russia and Ukraine contribute to a large part to most of the exports. That is where right now we are seeing the inflation is quite severe, not only on energy, it's also very severe in food supply. Only today, the European has been trying to convince Russia not to blockade the Black Sea port of Odessa because Ukraine exports most of their commodities from that particular port. Okay, so right now, this ongoing war is just adding on to an existing problem caused by the reaction to the pandemic largely, okay? And now the war is making things a lot worse. Now you can see on the chart here, this is the consumer price index for the United States. And of course, this is only reflecting at the retail end. And for the month of April, you can see the retail number right now is at 8.3%. Now compared to March, it was 8.5%. It seems that the inflation situation in the States seems to have taken a dip. Okay, but do not be fooled by this number. At 8.3%, it is still at 40 years high. Now, 40 years high, for those who have never had any experience on high inflation, I lived through that age, but unfortunately, those periods, I also do not realize or appreciate how high inflation was 40 years ago because I was in the army. So I was largely sheltered. You know, by the time I came to the workforce, inflation has largely been defeated. So I cannot honestly tell you how bad was bad. Maybe my parents' generation will be able to tell me how bad was then in the 70s and in the 80s. It was really, really, really bad. Now, At 8.3, you may think that it's nothing compared to the inflation that America and the world have faced in the 80s. But do not be fooled by this number, because of the way they recalculate the CPI numbers. Right after the inflationary period from 1973 to 1979, okay, in the states where they experienced double-digit inflation rate, okay, shortly thereafter, they started to revise the way in which they compute the CPI numbers, okay. Although it is 8.3, 8.5 recently, in actual fact, if we use back the 1980 computation of the CPI numbers, we are looking at somewhere near to 17%. Now, 17% is a very scary number, okay? Over the next few months, we're going to see this number continue to escalate, because the fundamental behind the inflationary surge is basically still around us, okay? And I think it's going to get from bad to worse before we get even better. So for the rest of this year, we can expect elevated inflation prices. So this is going to be something that we have to live with. And eventually all this is going to spill over into equity markets. And equity markets is something that we are all very concerned with, because those are assets that has actually saw a surge in asset value since the 2008-2009 global financial crisis. And the way the policymakers in the States and globally, okay, respond to the pandemic as well as to the war in Ukraine, especially the pandemic, okay, they use back the same formula as what they did in response to the 2008-2009 global financial crisis, in which we all know Lehman Brothers actually disappeared from the surface of this earth, okay? So what they do was they launched massive amount of quantitative easing. It's basically plain speaking, printing money, okay? But this day they don't even have to print, it's just a stroke of the computer keyboard, and then they created money in excess, okay? And the amount in which they increase the money supply is in the trillions of dollars. Now, this is the cost of the real inflation. A lot of time when we look at how central banks and policymakers respond to inflation, they believe that if they increase the cost of money, which is interest rate, okay, they could somehow tame this inflation. But they forget that this inflation has got nothing to do with demand. The nature of this inflation is not caused by rising demand. Typically, when you go to if you go for economic class, the professor will tell you, inflation is a function of higher demand. But in this case, it is not the case. The case here we have is supply shortages. When nations lock down their borders, supply chain has been disrupted. And now we have this ongoing war in Ukraine, which does not look like it's going to end anytime soon. It is a function of supply issue, okay? So by raising interest rates, I am afraid they are applying the wrong medication, okay, for this particular illness that we are seeing. By rising inflation, okay, they are going to compound the problem of the inflation rather than tackle the root cause of inflation. So this is my main worry. Now, as early as this week, okay, the chairman of the Federal Reserve, Jeremy Powell, has actually come in and said, now he's going to raise rate all the way until he kills off inflation. Now, this is a very dangerous move, because I believe he's using the wrong approach, okay, to the problem that we are facing. By raising interest, you're going to make everything cost so much more. Now, those with fixed income, those are the ones that's going to suffer the most. Those who have already retired, depending on the pension, these are going to be the person who's going to full blunt of this thing, okay? And what it does to asset classes, especially risky assets such as equity markets, it may not necessarily tame this issue. That's why when the first day when he made this announcement, in fact, the day when they raised interest rates by 0.5 point, okay, which is like 2 weeks ago, you can see that market actually reacted to the upside, okay, meaning to say equity market actually rose. On that very same day, the Federal Reserve did the most aggressive interest rate hike in recent memories by 0.5 point, because they have always been very, very cautious by 0.25, 0.25. And now you can see that the interest rate right now is at 1%. Okay, so how far can it go? Now, this is a chart. Okay, you can see that there's a shaded area here where you have this little red dot, those are the projected interest rates hike over the next few months. Because in his recent speech on May 18, Jeremy Powell says that starting in June, not only will they start to hike interest rate aggressively to tame inflation, they are also going to do another thing. They are going to reduce the balance sheet, meaning to say that they are going to do tapering. Okay. Remember, one of the tools in which they used to tackle the effect of the pandemic was not only to cut interest rate down to 0.25 or even lower. The Fed fund rate was effectively at 0.08, almost zero. Okay, and then they also launched massive amount of quantitative easing in a quantum that's even more than what they did for the 2008-2009 global financial crisis. So with so much money sloshing around in the financial system, it's inevitable that we're going to get inflation. Okay, so the issue here is money supply. They must cut down the money supply in order to be able to tame this inflation over the long period of time. Okay, so now this projection, market expectation is that the Federal Reserve will do something like 6 to 7 rate hike this year alone. So far, they have done 2. That means to say, if this expectation of higher interest rates is going to continue for the rest of the year, we are going to see at least 3 to maybe 4 to 5 more rate hikes. Okay, so if that's the case, we could possibly see by the end of the year interest rates in the United States at 3%. Now, at 3%, do you think the US stock market is going to react? Definitely, there will be a reaction. It's how much they can manage the market expectation. If, for example, during the next FOMC meeting, they hike interest rate more aggressively by 0.75, that will have the effect of causing the market to sell off. If they maintain at 0.5, the market is already comfortable with 0.5 because the Federal Reserve has done a very good job in actually telling the market what to expect, because market do not like surprises. If you raise interest rate more aggressively than what the market is expecting, the market is going to have an adverse reaction. It's basically to sell off. If the market has been told that it's going to be 0.5, the market will price itself to 0.5. So we will have to see over the next FOMC meeting whether they want to maintain at 0.5 or would there be a surprise of 0.75? Now, within the Federal Reserve FOMC committee governing body, there are already some governors, they are already advocating 0.75. So will this be the majority that will cause the Fed to actually take an even more hawkish view? Okay, this is what we are more concerned with, that they will do a more hawkish view. Okay, now this is the performance of the major US equity index, namely we have the S&P 500, we have the Dow Jones, we have the Nasdaq 100, for example, and then we have the Russell 2000. Now, all 4 major indices are the one that we are interested because they are available for trading using the CME Micro E-mini equity index futures. Okay, because these are new products and the market love these products to the point whereby when you look at the amount of volume and open interest recorded since its launch, okay, you can see that these are very popular product at the retail levels. Okay, of course, the fund managers do not trade the Micro E-mini, they trade the regular size S&P 500, the regular size Dow Jones. So basically, these are the ones that are actually geared towards people like you and me. Okay, we do not have very deep pocket, and we still want to be able to take advantage of the market volatility. Okay, the main thing is, where is the market heading? Is it going to go up? Is it going to come down? But this is not the latest chart. It did not include up to this morning closing price. This is the day before. It means it's up to Wednesday. Up to Wednesday, we can already see that of the 4 major equity index, you can see we have the S&P 500 year to date. That means based on market closing on 31st of December 2021 up to Wednesday closing, you can see S&P 500 is way down almost 17.7%, whereas the Dow Jones is the firmest of all at 13.3, means to say that it has fallen the least. Another way of saying is that as the market comes down, the Dow Jones is by far the strongest. It did not fall as deep as the rest. Now, the one that has taken the full blunt of the recent sell-off, okay, is the Nasdaq 100. By extension, it also refers to the Nasdaq Composite, but we cannot trade the Nasdaq Composite Index, but we can trade the Nasdaq 100, which is a derivative of the Nasdaq Composite. And we can also see that most of the tech stocks has suffered the most during this current decline. Okay, is this decline going to be just a technical pullback? So far it is, but if it goes deeper, then we are likely to be in a very different phase in which we're going to see much more robust decline going towards the end of the year. And all this create opportunities for us, because as traders, for example, people who do not have very long-term view, okay, I'm not talking about those investors who are value investors, for example, they want the dollar average as the market goes down. Now, try not to do dollar averaging during this phase of the market, because the way I see it, this is going to be a much more serious problem than just buying the dip. Currently, it looks like it is a technical rebound, technical pullback, okay? But it can quickly go wrong, terribly wrong, very, very fast, because the fundamentals are all wrong. Okay, we have high inflation, we have slowing economic growth. Let me just say the market is likely to go into a situation what I call a stagflation. Okay, now stagflation compared to a recession, which one is worse? I think both are equally bad, but stagflation can be very, very stubborn and it's not easy to tackle. Just look at Japan. Japan economy is in stagflation for the last 30 years. They have tried everything. They have tried negative interest rate. They have tried quantitative easing. Nothing works. So now if this thing spill over to the major economies like the United States, the Eurozone, you know, we are in serious trouble here. Though what we are looking at is something a lot more serious, honestly, okay? Now, you look at the two things that the Federal Reserve will have to do, okay? Federal Reserve has a mandate. It has two mandates, what we call a dual mandate. One is to maintain healthy economic growth. That means to look at the GDP, okay? In this chart, you can see the GDP represented by the blue line, okay? That is the GDP. Now, of course, what we have seen so far this year, we are just past Q1 of this year, and the number is terrible. It's negative 1.4. That means US economy is already sliding, okay? From where it was near 6%, that is a massive drop in terms of economic activity, okay? So this is giving us a warning as to, if you look at the annualized, of course, in this chart here, I go back all the way to 1960 when I was born, okay? So I can see how the US economy has been performing up to the war in Ukraine. It appears the US economy is on the recovery, but the impact of that war can now be felt. You see, this number was measured all the way up to end of March, and the war in Ukraine started on February 24th. So for that 1 month after the war started, this number is being captured in the Q1 GDP reports. Then on the other hand, you look at the brown color bar. The brown color bar reflects the annual inflation rate in the States, okay? Of course, we only passed the first quarter of this year. So at 8.3 is the latest number for the month of April. It's at 8.3. Remember what I said earlier on? If you use back the same way they compute CPI numbers, like back in 1980s, that number is closer to 17%. Now, 17% is a number that's even higher than the worst inflation that we saw back in 1980 in the States. So definitely we are in very, very serious trouble here, okay? So this creates not only fear among the market, but to us as traders, these are what we call opportunities. Between the two devils, the Federal Reserve on one hand must maintain healthy economic growth, okay? On the other hand, they must also manage inflation, okay? They are saying that long-term inflation target is 2%, but looking at 8.3, they are 4 times higher than the target price of inflation, okay? So the Federal Reserve knows that they are in serious trouble. So that's why the Federal Reserve Chairman said his first priority is to defeat inflation, but I think he's using the wrong tool, honestly, because by raising interest rate, it's not going to cause a dent in inflation. Mark my word, in the next few months, you're going to see inflation at still very high levels, okay? And worse still, we are beginning to see food shortages appearing, okay? In the States, they are already short of baby formula. Very basic element. Babies cannot find infant formula to feed, so that is just a glimpse of what we're going to face. As the war in Ukraine continues to drag, we are going to see more problems coming out, because we can see that Ukraine alone and Russia combined contribute about 30% of the global supply of wheat. 30%. With Ukraine now deep in war, the farmers cannot do anything about planting, right? Right now we are in the planting season. If they don't plant now, nothing is going to come out at the end in a few months' time when it comes for harvesting. So we're definitely going to see the delay effect of food shortages. Everything from your pasta to your noodles to your to your bread, for example, all this will feel the impact of higher prices. Okay. And then of course, energy prices is still going to be very high. Okay. And now because of the sanction imposed on Russia, nobody can buy energy from Russia. Or globally, we're going to see energy prices going to go up. And energy is the input cost of everything that goes into production. Without electricity, nothing gets produced. Okay. So whether it is energy, whether it is food, we're going to see it in the US equity index. Okay. Now, for Federal Reserve Chairman, I think he has very little option between the two evil. Okay. Do you tackle inflation first, or do you tackle a possible recession? Right now, there's no recession, but the Q1 GDP reports already warn us that US economy is taking a dip. Okay. So the most visible right now is the inflation. So he has to tackle inflation first. But if he becomes too aggressive in pushing interest rate high, okay, he may run the risk of tipping the US economy into a recession. And this year is an election year in the States. The incumbent, which is the Democrat Party, which President Biden is now serving his midterm. Okay, he needs to get elected, or at least his party need to get elected to control both chambers of the US Congress. Basically, he needs to win a far higher majority in the Senate as well as in the House of Representatives. If the economy goes into a recession, he can kiss that goodbye. Okay, but I think the Democrats understand this issue. Okay, that's why they need to keep the war going, because in any election year, okay, one way for the incumbent or for the for the ruling party to stay in power is to divert attention. Okay, if the economy is not doing well, people will be complaining about higher cost of living, life is getting more difficult. But if you tell them there's a common enemy, okay, the approval rating of the incumbent president is definitely going to rise. Right now, I think his approval rating is below 50%. I think as last I saw was 42%. Okay, at 42% is probably the lowest approval rating for any sitting president. So right now we have an issue, we have an economic issue, we also have a political issue, and the way I see it, there's nothing that within the horizon which I think will do well for the economy. Okay, so this is where I think we are headed. And like I said, as traders, what we do has got nothing to do with the real economy. I say that again, what we do for a living, as far as traders are concerned, has got nothing to do with the economy. Economy doing well, we can always buy equity index. Okay, if the economy is not doing well, we can sell short the index. Unlike investors, investors make money as they accumulate positions in a rising market. Okay, they can do dollar averaging as the market goes up. But if the market started to dip, like what we are seeing now, for 5 months now, we can see US equity has been falling up to last night. Okay, the Dow Jones actually has the lowest traded price for this year, and that is telling us something. As far as you're concerned, regardless of whether it's inflation, stagflation, or recession, there's only one conclusion. That means to say there are a lot of opportunity for those in the know and know how to take advantage of this. Because at the end of the day, we cannot prevent market from falling. But if we have to fall, do we have instruments or products that will allow us to profit from something that is totally beyond our control? I think we have. This is the time to take a look at some of the instruments at our disposal in which we all can participate, which is the CME Micro E-mini Equity Index Futures. Okay, this is something that we'll be talking about on the 25th, and I hope you guys do come on board and listen to what I think maybe will happen, which I really lay out the basic broad outline of what I think is going to happen. There you have it.
Thank you very much, Daniel, for the preview. I think you mentioned a very key point here is the expectation. So what does the market expect the Fed to do? Okay, so for those that are interested to join the webinar that Mr. Daniel has just mentioned on the 25th of May, you can just register from our website at Phillip Futures. Okay, and once again, if you are interested to find out how you can participate, trade the micro US indexes futures, feel free to drop us a message on the Facebook, and one of our representatives will try to contact you as soon as possible. Okay, so that's all for today's podcast, and thank you very much, Daniel. I will see you next round.
Thank you very much, William. I'll see you guys on the 25th, and I think I can promise you something very interesting. Thank you very much.
Thank you. So join for the sweets. Okay, thank you. Bye bye.
Right. Bye bye.